Up to this point, we've looked at accounts receivable. Now let's change gears a little bit and look at notes receivable. For those watching on YouTube, again, go down to the description and you can get a link to this handout. A note is created when a company grants credit, and typically when they grant that credit, they receive in exchange for it a signed document. And we call that signed document a promissory note. Now, these have a little bit higher legal weight than accounts payable. Typically, accounts payable verbal. For example, power. You called the power company and they hooked it up. You didn't sign a formal legal contract for a 5-year period at some interest rate. A note is a signed legal contract. In that promise to pay, it typically will bear interest. So notes do bear interest, even if it is at a rate of 0. So you go and buy a new car and you have a note that you sign with the company for 0% for 60 months to encourage you to buy their vehicle. That 60-month note at 0% is still a promissory note and it still bears interest. It just bears interest at a rate of 0. So what creates notes? Well, normally a note's created when a company lends to another company or to an individual, so you can lend money. Next, you may purchase and need more time. So, for example, a car. If you go and buy a car, that's a purchase, so you have a note receivable because you can't pay for it in 30 days. You need a longer period of time, and usually for a company to allow you to use their assets for a longer period of time, they're going to charge interest. So a lot of times this would be the sale of a product that requires a longer period to repay than a normal 30-day window, say, than your power bill. Or you can do it in settlement of an existing account receivable. So we already have a 30-day account and we know we're not going to be able to pay, but in order to keep that relationship with the customer, we may go back to them and say, you know what, if we can extend this period for 90 days, I'll give you some interest and sign a note with you, and that'll give me more time for my cash flow to get back to normal. As mentioned above, notes do typically bear interest. Well, they do always bear interest. So when dealing with notes, there are a few things we must consider. One is the principal balance. The principal is also known a lot of times as the face. This is the amount you actually borrow. So if you sign a note for $20,000, that's the note payable. That's the principal amount. Then the next thing we have to understand is the interest rate. So again, all notes will bear interest. So we need that interest rate. Now keep in mind this will be expressed as an annual rate. So if it's 12%, they mean 12% per year. So if you only hold the note for 60 days, you would not pay 12%. You would only pay 2% in interest because that would be 2/12 out of that full year. All right, and then the last thing we need to understand is there's a maturity date. When do we actually have to pay the note back? Now, in this, we're not going to look at installment notes until a later video. This is we borrow the money, we pay it all back at maturity, including the interest. Okay, installment notes are a little bit different and typically they're longer periods. So we'll look at installment notes a little bit later on. Now, when we're looking at notes, we have to be able to calculate the interest on the note. We did this a little bit in a prior video, but let's go in here and really look at how do we calculate interest on these notes. Below are three notes receivable currently on a company's books. Calculate the total interest and indicate the amount of interest revenue the company should report each year. So we've got an $80,000 6% 9-month note on June 1st of 2021. So the first thing it wants us to do is the full total interest we would record on this note. So to calculate interest, there's a neat little formula we can always use, and I call it PERT. P-R-T. Principal times rate times time. So a neat little way to remember it is just PERT. P-R-T. So for each of these, we're going to do PERT. We're going to take the principal. So on this first note, we're going to take $80,000. That's our principal amount. Then we're going to multiply that $80,000 times the rate that's stated on the note. So in this case, the rate of interest is 6%. So we're going to multiply that by 6%. Remember to convert, it'll be 0.06. And then we're going to multiply that by time. How much time is going to pass? Now remember, that interest, that 6% there, is expressed in annual terms. So we only pay 6% if we hold it for a full 12 months, or 12 out of 12. Are we going to hold this for a full 12 months? No. This note should only last 9 months. So we're going to take that and we're going to multiply it by 9 out of 12. So in your calculators, do 80,000 times 0.06, or 6%, times 9 divided by 12, and you should end up with a total interest of $3,600. So that's our total interest. Now remember, in accounting, we have to be careful in that we recognize it in the proper time period. So for this note, it's going to begin on June 1st and it's going to last for 9 months. So what happens is we're going to probably have a year end at December 31st. So from June 1st to December 31st, that's going to be our interest for 2021. So even though the total interest is 36, we're going to have to record it in 2 separate accounting periods. So first off, how many months is that? Well, you're going to count all of June, July, August, September, October, November, and December. So that's 7 months. So we're going to prorate that down for 7 months. So 80,000 times 0.06 times 7/12 would give me how much I would need to record here in 2021. So again, pause the video, take out your calculators, and do our formula there. All right, hopefully you did that and you ended up with 2,800. So that's the amount I would recognize in 2021. That means 2 months of interest I would need to recognize in the next year. So you can either multiply that out again, or you know it's 800 because that's the amount you need. But you could do 80,000 times 6% times 2/12, and that's the amount you'd need in 2022. If you add the 8 and the 28, you end up at the 3,600. All right, let's look at the next one. PERT, principal, 15,000 times rate here is 8%, 0.08, times time. This is going to be a 6-month note. So 15,000 times 0.08 times 6 out of 12, or divided by half, gives us total interest on this note of 600. Now, how much of that will be in 2021? Well, only 2 months would be in 2021. So November and December would be all we would record for 2021. So multiply that out for us and see what you get. All right, hopefully you paused the video and you ended up with 200 in 2021, which would be 2 months, because 600, that would be $100 per month. 2 months there, that means 400 would be recognized here. If you wanted to write out the formula for 2021, it'd be 15,000 times 0.08 times 2/12. That would be the 2021 number right there. And then if you wanted to do the 2022, you could do 15,000 times 0.08 times 4 out of the 12. So that splits, notice the total is 6, that splits that 6 in the proper time period, the proper year. All right, last one down here. Let's start with the total. I guess I should have labeled all these. The total is 24,000 in principal times a rate of 7% times 5 out of 12, because this is a 5-month note. So pause the video here, go to your calculators and see what you come up with if you multiply that out. All right, hopefully you paused and did that. I end up with 700 in total interest. So again, you took 24,000 times 7% times 5 out of 12. All right. How much of that would be recognized in 2021? Well, July, August, September, October, November. This note would mature, so 100% of the interest would be recognized this year. Because if we sign it on July 1st, 5 months later would still be within 2021. So we would not accrue any interest in 2022. Okay? All right, now that we understand how to calculate interest and how to get it in the proper time period, let's look at the journal entries and the analysis for a notes receivable. On November 1st, Elmo Inc. sold merchandise to Abby Inc. for $12,000 and received a 3-month 10% promissory note. Record the necessary journal entries from the November 1st sale through the maturity date of the note. So again, In this case, we are selling a good. Remember, we could sell a good to someone and receive a note. We could lend them money, or we could replace an existing account. So here we're selling goods. So we're going to debit the note receivable because it is a receivable to us, but it's a signed legal document, so it's a little bit different than an account. For the full $12,000, the principal amount, we're going to record and hold that note at that balance until we pay or receive the payment on it. And then we're going to credit our sales revenue because in this instance, the receivable is created through the sale of a good. So we're going to put that in at $12,000. Now, how does that impact our financial statements in this case? Well, first off, this is November the 1st. On November 1st, our receivables are always assets, are going up. So our assets are going up 12. Sales revenue is a revenue. Remember, revenues show up on our income statement, so our revenue is going up 12. When revenues increase, our income increases. And when income increases, our stockholders' equity, because revenues is part of retained earnings, which belongs on the balance sheet. All right, now notice this was November 1st. This is a 3-month note, so it's not going to mature until February 1st. So that means it's going to be split between the years. At December 31st, we would need to record an adjusting entry. So what we would need to do there is figure up our interest. We would take our $12,000 principal times our 10% rate times, in this case, now granted this is a 3-month note, but we only need 2 of the 3 months because I only need November and December to record as of the end of the year. All right, so when you multiply that out, you end up with $1,200 in total interest divided by 12. That's $100 a month, so $200 in interest. So we do need to record it to match the proper time period. So we're not going to hit notes receivable. You always want to hit interest receivable there for the $200. And since it's a receivable, it's generating interest revenue to us. If this were a note payable, it would be generating an expense for us. But it is a receivable, so it's generating revenues. Again, this is December 31st when we're recording the adjusting entry. Our assets, the receivables going down because our counterparty now owes us $12,200 in total for this note. Our revenues are going up $200, which makes our income go up. And since revenues are part of retained earnings, our stockholders' equity will also go up. Notice cash flows have not been involved because there's no cash at this moment. All right, finally, on February 1st, we received the payment from our client. So what are they going to pay us? Well, one, they're going to pay us cash. So we know we're going to receive cash for the note. Now, how much cash are we going to receive? Well, that's called the maturity value. The maturity value of a note equals the principal of the note plus the total interest. Now, we know the principal of this note is $12,000. What we don't know is the total interest because we haven't calculated it yet. So to find total interest, we would take $12,000 times 10% times 3/12 because that's the total amount of interest. And that would be $300 because remember we said it's $100 per month. So our maturity value is $12,300. So when our customer pays us, that's what they're going to pay us. They're going to pay us $12,300 if they paid the note in full, so receipt of payment. Now, why did we receive it? Well, one, they're paying off their note, so we're going to get rid of the note. The note was carried at $12,000, so we're going to take it off at $12,000. What else? Well, now we need the $300 of interest, but be careful. A lot of people want to slap in here interest revenue $300. No. We've already split it, so we've recognized a portion of the interest already, so make sure you take into account any interest you've already recorded on the note. So you're going to go in and you're going to record your interest receivable at $200. And then finally is our interest revenue. So notice when this note comes due, it's impacting a lot of our income statement and balance sheet. Okay, there's a lot going on here. One, our cash is going up, our note and interest are going down, and then our interest revenue is going up. Okay, so how does that impact the financials when we collect a note? Well, February 1st. In total, our assets are going up $100. You're like, whoa, wait a minute. What's going on here? Well, think of it this way. Cash is going up $12,300. So let's just go down here just so you can see it. Cash goes up $12,300. But then if you notice, the note goes down by 12, so that's a subtraction of 12. But then the interest receivable goes down by 200. So here is a reduction of assets by 12 too. So the net impact is that $100 increase, okay? Now, what else is going on? Well, that takes care of your cash and receivables. The last thing is your revenue piece. Your revenues are going up by 100. When revenues go up, so does income. When income goes up, so does our equity. Okay? All right. So, when we look at that, we see each of those pieces. Now, here we have to be careful. What is this cash from? Is it from an investing or from an operating standpoint? Notes receivable can be a little tricky. If we just lend, $50,000 to someone for 5 years, that's a investing activity because that's an investment because we're going to get interest return. In this case, though, that note was used to generate sales revenue, so you could argue that this would be an operating activity. Now, if you're in my class and you put investing activity for a note, okay, I'm not going to count it wrong, but this would be considered a current operating asset in this case because it was created from a sale, so the note could be an operating activity. It could also be an investing activity if you were lending out cash. So in that, be really careful which way you actually treat it. This is operating solely because it was generating sales revenue, so you could classify it as operating. Again, if you put investing, I would be fine with that. Notes receivable typically are investing activities, which we will look at in the next example. All right, on February 1st, Cookie Monster loaned Big Bird $10,000 and received a 12-month 6% promissory. Record the necessary journal entries from February 1st to the maturity of the note. So here we're doing a 12-month, so here we just lent money out to Big Bird in that. All right, so what are we going to do? Well, February 1st, we're creating the note. So here, we're going to go in and create the note. We're going to debit our notes receivable just like before. We created the note. And we're going to credit cash because in this example, we're lending cash out. Now, this one's going to be a little bit different. What type of activity is this? Well, that is not a current operating asset. It is not related to the process of the company. So in this case, this is going to be an outflow from investing activities. Okay, a little bit different than the one above. Notes can flip-flop. That's the reason I say if you accidentally put interest there because it's a note, or investing there because it's a note, that's perfectly fine. But we have to be careful with notes receivable sometimes. All right, so investing activity, we've just lent money out. We are investing. We're trying to get an interest return here. How does that impact our financial statements? Well, that's simply an up and a down in our assets. So assets are going both up and down in this example. Our income statement is not impacted. Our cash flow is investing activities. All right. Now let's do the necessary adjusting entries. Time has passed, February through December. So step one, we know we're going to record interest. So it's going to be interest receivable, just like before, and interest revenue. Now comes the dollar amount. So again, pause the video and work through the dollar amount. All right, so let's see, how much do we have here? Well, you take PERT, principal times rate times time. We got a principal of 10. We're going to multiply that by a rate of 6%, 0.06, times how much time out of 12? Well, February 1st, so you're going to count all of February, March, April, May, June, July, August, September, October, November, and December. So almost a full year, but not quite. It's 11 out of 12 months. Okay? So when you do that, you get $600 per year or $50 per month. So you're going to end up with $550 in interest that would accrue at this point at $50 per month. Again, the impact here on December 31st to our financial statements, our assets are going up by $550. Our revenues go up $550, which makes our income go up by $550, which in turn causes stockholders' equity to go up $550. Statement of cash flow is not involved because, again, neither of those are cash accounts. All right, and the last thing is our February 1st comes around and we will have this note mature on us. We will collect the payment or receive the payment there. All right, so one, how much are we going to receive? Well, it's the maturity value. Remember, that's principal plus interest. So first off, let's find the total amount of interest. You can do this in your head, but just so you can see the formula, I'm going to put it out here for you. It is a 1-year note, so it'd be 12 out of 12, so that is $600 in total interest. Now remember, we've already recognized $550 of it last year. Keep that in mind. So to calculate our maturity value, how much cash did we receive? It was a $10,000 note plus $600 in total interest, so we should receive $10,600 in cash. So that's the amount we received. So we're going to hit cash, $10,600. Now what else is going on? Well, we're going to remove the note receivable from our books. Remember, the note was placed and carried at 10. We'll do installment notes a little bit later. We need to remove the interest receivable that we recorded last time. Remember, we did record $550 already. And that means we need to recognize 1 month of interest this year as revenue. We simply split that $600 between the 2 years that's impacted, last year and this year, okay, in that. So how does that impact us? Well, our net change in assets is 50. You're like, whoa, that's weird. Well, net change in total was 600, but keep in mind, we're actually removing 10,550 here, and we're putting on 10,006. So at this moment, only 50 this year. But notice we did gain 600 in assets over this year period. You're like, we lost 10. Yes, we gained 600. So at the end of the day, we end up with a positive in our assets of $600. All right. Now, in that, our revenue is going up 50. Our expenses aren't impacted. Our net income goes up by 50. When income goes up, so does stockholders' equity. Statement of cash flows, this would be an inflow from an investing. I keep wanting to say operating today. An investing activity. When we lend money out, typically we are investing simply to get a return, an interest return there, and that's the case, okay? So typically speaking, notes receivable will be an investing activity. Occasionally they can make the switch over to operating if it's used normally in the operations of our business to generate sales revenue. All right. Y'all have a wonderful day. I hope this has helped clarify notes. We'll see you next time.